Welcome to Crisis in Perception, where we examine the systems shaping our world one book at a time. Today we are diving deep into a really crucial systemic question, one that I think underpins so much of the chaos we've seen over the last decade or so in global finance.
Hmm.
How did global economic stability rely for nearly 40 years on a very specific U.S.-centered system of surplus recycling? And more critically, what fatal structural weaknesses were instantly exposed in Europe, particularly the Eurozone, when that global system collapsed so violently in 2008?
This is an analysis we need now more than ever. I mean, if you've watched Europe since the financial crisis, the persistent stagnation, the relentless imposition of austerity politics, that never-ending Greek debt drama, it often gets framed as a moral failing.
Right, the lazy Southerners versus the thrifty Northerners narrative.
Exactly that. But the truth, as laid out in our source material today, is it's far more structural. It stems directly from a fatal flaw that's inherent in the Eurozone's economic architecture itself, a flaw which was, only masked by this huge external global engine that eventually blew up.
And that structural imbalance is precisely our mission to this deep dive. We are committed to a systems-level analysis. So we're going to be focusing entirely on the economic architecture, the incentives, the feedback loops. We're going to do our best to avoid the trap of national stereotypes, any kind of policy advocacy or moral judgments about specific countries. We're just looking at the machine, the gears, and, well, the incentives driving the actors within it.
And our guide today is Yanis Varoufakis, an economist who not only theorized about these systems, but was, you could say, thrust onto the very front lines of the crisis. We're pulling key insights from his work, Europe After the Minotaur, Greece and the Future of the Global Economy.
Which is actually an edited portion of his larger, really definitive analysis, The Global Minotaur.
That's the one.
And Varoufakis is such a unique voice in this conversation. He's an academic, of course, but he also famously served as the Greek Minister of Finance and an MP for the Syriza party during the most intense, really the most heated years of the Euro crisis.
And that experience is just vital here. He wrote this book in the immediate context of Syriza's 2015 election victory, right when the Euro crisis was boiling over again. So his motivation was explicitly to reintroduce reason and systems thinking into what he argues was an emotional, almost irrational global economic order that was just being run by self-defeating policies.
To really understand his diagnosis, we have to start with the historical setup, that critical shift that happened post-1970s. For most of modern history, a global hegemon like, say, Britain in the 19th century or the U.S. after World War II would run surpluses. They were the world's bank, right? They were lending out capital to maintain stability. But Varoufakis argues that after the end of the Bretton Woods system in 1971, the U.S. completely reversed the standard role.
It's the key paradox he identifies. The period that followed 1971 saw a radical reversal of both trade and capital flows. So the U.S., the global hegemon, actually strengthened its dominance and maintained global stability by, and this is the key, willfully enlarging its deficits.
Which is just so counterintuitive.
It's totally unprecedented. Instead of being the world's prudent banker, the U.S. essentially became the world's irresponsible yet, deeply necessary consumer.
That seems to fly in the face of standard economics, which so often treats large, persistent deficits as a sign of imminent decline. But here, the deficit is framed as a source of power and global stabilization. How does that actually work?
It works because the U.S. deficits created the necessary aggregate demand to absorb the exploding industrial surpluses of the rest of the world. So you're talking places like Japan, Germany, and then later, of course, China.
Ah, okay.
So this ability to run these gigantic debt-fueled deficits provided the necessary mechanism for global growth. At the same time, the recycling of those profits back into Wall Street fueled the massive financialization that defined the pre-2008 era. And that financialization, ironically, is what implanted the seeds of the system's downfall.
So if we strip away all the historical complexity and just use the metaphor, what is the core argument? What happens when the Minotaur dies?
Well, the central thesis is this. Global economic stability from about 1971 to 2008 was achieved through a U.S.-centered global surplus recycling mechanism. That's the Minotaur.
Okay.
So when the 2008 financial crisis killed that mechanism, Europe was instantly exposed as having a fundamentally flawed economic architecture, which was the Eurozone. It was, an incomplete machine, totally incapable of self-correction or balancing its own internal trade flows. And it just immediately cracked under the strain.
Okay, let's unpack that central metaphor and its mechanics. We really need to define this Minotaur system, the Global Surplus Recycling Mechanism, or GSRM in the fullest detail, because understanding its function is just so critical to understanding the Eurozone's flaw.
Right.
What was this circular flow of goods and capital that defined the post-1970s world? It's often visualized as this gigantic figure eight.
Fundamentally, it was a massive self-reinforcing flow that relied on the U.S. playing the role of both the ultimate consumer and the ultimate financial sponge. So in the first loop, the U.S. absorbed an enormous portion of the rest of the world's surplus industrial products.
So all the stuff being made in factories everywhere.
Everything. And this was manifested in America's consistently gargantuan trade deficits and its net imports.
So the U.S. consumer, fueled by easy credit, essentially became the global buyer of last resort. They were keeping factory floors humming everywhere, from Stuttgart to Shanghai.
That's the demand creation component, exactly. But this only works if the money flowing out of the U.S. is continuously recycled back in. And that's the second loop.
Ah, the recycling.
The profits earned by those surplus nations, Germany, Japan, China, the OPEC states, from all their net exports were daily returned to Wall Street. They weren't sitting in banks in their home countries. They were desperately seeking higher returns in the American financial markets. That was the recycling component, manifesting as massive net capital flows into the U.S.
And that capital influx, those repatriated profits, that's what Wall Street used to become the world's most aggressive financial engine. This is where that term financialization becomes so relevant, right? Wall Street takes these foreign profits and just toto charges them.
Absolutely. Wall Street took this capital, we're talking hundreds of billions of dollars per year sometimes, and engaged in increasingly sophisticated and, let's be honest, often reckless financial engineering. They weren't just taking deposits, they were minting vast pyramids of private money through instruments like collateralized debt obligations, CDOs, and, all sorts of securitization.
And where did that turbocharged capital go?
It was channeled into three primary uses, which is what completes the cycle. First, it provided an endless supply of credit to American consumers, allowing them to buy even more imports. It's a circular demand generator.
Right. More credit, more stuff from abroad.
Second, it went into direct investment, or equity, into U.S. corporations. And third, it was used to purchase U.S. Treasury bills, which is what funded the federal government's own budget deficit. It was a perfectly closed loop, but, one built on sand, because it relied entirely on U.S. deficits. And this is the critical systems requirement. The system required America's gigantic twin deficits, the trade deficit and the federal government budget deficit, to close the global circular flow.
So if either of those had shrunk,
If either one of those deficits had shrunk substantially, the recycling mechanism would have failed to generate the demand necessary to absorb global surpluses, and the global economy would have been plunged into stagnation decades earlier.
so when we talk about the 2008 crisis, we're not just talking about subprime loans or a few banks making bad decisions. We're talking about the shattering of this indispensable global engine that had kept things stable for nearly 40 years.
It was the death blow to the Minotaur itself. I mean, those colossal pyramids of private money Wall Street had built, those CDOs and securitized instruments, they suddenly auto-combusted and just turned to ash.
Why, though? What was the trigger?
They imploded because the underlying collateral, specifically all those subprime mortgages, failed en masse. And this violent combustion instantly destroyed Wall Street's capacity to continue acting as the hub that closed the global recycling loop. The lubricant that kept the capital flowing and financializing just evaporated.
Hold on, I have a question here. If the U.S. government budget deficit actually doubled post-2008 because of the stimulus and the bailouts, and the trade deficit remained high, why did the recycling mechanism fail? Weren't the numbers still big enough? How do we differentiate between a systemic collapse of the mechanism and just, say, a temporary financial panic?
That is the right critical question to ask. And you're right, the numbers were indeed big. The budget deficit, as you said, massively increased to $1.4 trillion in 2009, stabilizing around $1.2 trillion by 2011. But the capacity to recycle surpluses at the necessary pace had vanished, even if the deficit size remained large.
So it's not just about the amount of money, but the machinery that moves it.
Exactly. The mechanism wasn't just about deficits. It was about the financial apparatus to leverage and recirculate those flows efficiently. And we can measure this loss of capacity empirically in several ways, and the data is pretty striking.
Okay, let's see it.
First, look at demand generation. By 2011, America was generating 23.7% less demand for the net exports of the major surplus nations, the Eurozone core, China, Japan, than the pre-crisis trend required.
24% just gone. That's staggering. That translates directly to factory slowdowns, lost export jobs, and manufacturing stagnation in major economies all over the world.
Precisely. And second, look at where foreign capital was not going anymore. Foreigners reduced their overall holdings of U.S. assets by 56.48% compared to the trend level that would have existed had the crash not happened.
Wow. So this wasn't just a nervous pause, it was a profound flight from the productive side of the U.S. economy.
It was. And you can see that flight most clearly in the corporate lending sector. The net capital flows ending up as loans to U.S. corporations swung violently. Before the crisis, in 2006, foreigners were massive net lenders, pouring $500 billion into the U.S. private sector.
And after?
By 2011, this had reversed to a negative $50 billion. They were now net borrowers from U.S. corporations. That $500 billion swing is a complete structural reversal in the foreign funding of the U.S. private investment and credit machine.
That's powerful. Foreign investors stopped funding the credit machine and actually started pulling capital out of it. It's hard to overstate the significance of that data point alone because it confirms the Minotaur's mechanism for leveraging foreign money was just broken.
It confirms the private money mechanism was dead. And crucially, only one flow continued almost at the trend rate. Foreign capital pouring into U.S. public debt, buying treasury bonds.
The safe in.
The only safe haven. This wasn't a sign of confidence in the U.S. economy's productive capacity or the Minotaur's health. It was purely money desperately seeking safety in the world's only reliable reserve currency during a period of total global disarray. It was a liquidity preference for safety, not a mechanism for growth. The Minotaur was functionally defunct.
And the moment that global engine stopped providing that external energy, the spotlight shifted instantly to the Eurozone, which, as you said, was running on the Minotaur's life support. Varoufakis describes Germany and the other surplus nations as the Minotaur's European opposite, a simulacrum. This is where the inherent structural flaw of the Eurozone became explosive.
That phrase, European opposite, is so descriptive. The German economy, like the Minotaur, achieved tremendous export dynamism, but it did so by draining demand from the rest of Europe.
Ah, okay, so it was an internal drain.
Yes. On paper, the aggregate Eurozone economy looked healthy, total income was rising. But beneath the surface, the industrial sectors of deficit nations like Italy, Spain, and even France entered a slow, grinding recession because of the overwhelming pull of German surpluses.
And this takes us directly to the structural design flaw embedded in the Maastricht Treaty, the very blueprint for the Eurozone. If the Minotaur was a surplus recycling mechanism, what essential piece of plumbing was deliberately left out of the Eurozone?
The omission was catastrophic, and it was deliberate. It reflected decades of German insistence on a very particular model. The treaty included strict convergence criteria, the 3% GDP budget deficit limit, the 60% debt to GDP ratio, and that critical strict no transfers no bailouts clause.
Which was designed to prevent fiscal free riding by member states.
Right. But the absolutely vital omission was the lack of any explicit functioning surplus recycling mechanism. If you think about historical precedents, the U.S. global plan after World War II included the Marshall Plan. What was that? It was essentially a mechanism for injecting generous capital into defeated nations like Germany and Japan. The U.S. understood that balancing surpluses and deficits was key to systemic stability.
So the Eurozone was founded on the opposite principle of its successful post-war predecessors. It had a mechanism for imposing discipline, but no mechanism for guaranteeing stability or solidarity, which is what surpluses naturally require in a fixed currency union.
Exactly. The stated objective was stability through rules, but the practical outcome, according to this analysis, was to cast in stone the obligation of the deficit countries to provide Germany with net effective demand for its exports, without any counterbalancing capital flow mechanism provided by the center.
And German internal policy reinforced this structural advantage within the union, creating that simulacrum effect. How did Germany engineer these competitive gains once it was locked into the common currency?
It did so through a policy of competitive wage deflation, particularly after reunification. Germany intentionally restrained wage growth, so it was significantly below productivity growth, and they did this for a sustained period. This domestic strategy actually mirrored the Minotaur's domestic policy of declining real wages in the U.S., but when applied here, it created vast domestic surpluses.
Let's just pause on that mechanism for a second. If Germany's productivity is rising faster than its wages, their goods become cheaper relative to labor costs compared to, say, France or Italy, where wages might be rising closer to or even above productivity.
Precisely. And because the common euro shields Germany, meaning Greece or Italy can't devalue their currency to regain competitive pricing, this wage restraint provided a permanent structural gain. German export dominance just massively reinforced itself within the monetary union, exporting stagnation, deflation, and low demand into its own European backyard.
It was a mercantilist strategy operating inside a single currency zone.
That's a very good way to put it.
So this faulty architecture, no recycling mechanism, was totally masked as long as the global Minotaur was healthy. It provided a source of demand relief to the European deficit countries through their net exports to the U.S. But once the Minotaur crashed in 2008, taking away that external demand, the Eurozone's internal imbalances became immediately explosive.
It was an absolute system certainty. The architecture of the Eurozone was only viable externally. Once that external force field vanished, the internal dynamics, the German simulacrum draining demand and creating these deep current account imbalances with the periphery, went from being a slow structural problem to an acute, violent crisis.
This brings us to the moment of crisis post-2008, specifically the European response, starting with the bank bailouts. You highlighted two profound differences between the U.S. and EU bailouts. Let's detail those.
The differences were crippling. First, the U.S. dollar is the world's reserve currency. The Federal Reserve and the Treasury can effectively print blank checks and mutualize risk across the whole nation without immediate acute market consequences. The euro is not that currency.
So Eurozone states can't just print their own national currency to cover their debts.
They can't. And second, the Eurozone's architecture, defined by the Maastricht Treaty, insists on fragmentation. You have a common currency, but separate public debts, separate national banking supervision, and critically, no central fiscal authority to absorb shocks or recycle capital.
So when the financial earthquake hit,
The losses landed entirely on the individual sovereign states. I mean, imagine the sheer impossibility of every U.S. state having to bail out its own banks without any federal financing or risk mutualization. It's unthinkable.
so what happened across the Eurozone was this rapid, involuntary socialization of massive private debt. Banks' colossal pre-2008 losses, all those toxic assets they held, were instantly converted into sovereign debt or public debt.
And this is the moment where the financial sector had an incredible and deeply cynical epiphany. Banks and hedge funds, many of whom had just been rescued with hundreds of billions of euros of public money, realized that the strain on public finances caused by the recession and their own bailouts would likely push the weakest state toward default.
They saw an opportunity.
They immediately shifted their focus from banking to betting. They start betting heavily on state default, mainly through these speculative financial instruments called credit default swaps, or CDSs.
Okay, before we move on, what exactly is a CDS in this context? And why is that banking behavior betting against the very state that just saved you, the essence of the problem?
So a credit default swap is essentially an insurance contract. A holder of, say, Greek debt could buy a CDS from a bank, paying a premium, and if Greece defaults, the bank pays out the insured value.
Simple enough.
But here's the twist. You don't actually need to own the underlying debt to buy the insurance. So banks, including those that were just rescued with public funds, started buying protection, essentially betting that states like Greece, Spain, and Italy would fail. This massive betting drove up the insurance premium, which then becomes the rate the market charges those states for their debt.
So the Greek crisis in late 2009 was the entry point where this toxic feedback loop became visible and acute.
Yes. When the newly elected Greek government announced its true deficit was over 12% of GDP, much higher than had been previously reported, the price of CDSs on Greek debt exploded, and the interest rate the state had to pay soared to unsustainable levels literally overnight.
And Greece was scrambling for assistance.
And it was met by German Chancellor Angela Merkel's famous 9 cubed.
The triple no.
No bailout, no interest relief, and crucially, no default. This triple no meant Greece was forced into a state of increasing insolvency, forced to borrow at usurious rates, and forced to pretend it could survive a storm that its system was not designed to weather. It's a completely inconceivable position in public finance, telling a failing entity that it can't be rescued, can't get relief, and can't file for bankruptcy.
And this set the stage for the expensive loans, the initial 110 billion, and then the subsequent structures like the EFSF, the European Financial Stability Facility. But Varoufakis argues this medicine was worse than the disease.
It was worse because it was symptomatic treatment, not a structural correction. The loans weren't given to Greece for investment or recovery. They were given to service the debts held by German and French banks and to fund the subsequent austerity measures. It simply replaced private debt risk with public debt risk, without addressing the lack of demand or the need for a capital recycling mechanism.
Let's use that extremely vivid analogy of the tumbling mountaineers because I think it perfectly captures the systemic failure inherent in the Eurozone's architecture.
Yeah, it's a great one. You visualize that group of mountaineers tied by a single rope on a steep cliff face. The common currency, the euro, that's the rope binding the states together,
Okay.
but their separate public debts, the fact that they have no federal safety net, make them individually and sequentially vulnerable.
Okay.
So when the 2008 financial earthquake hits, the weakest link, let's call her Helen for Greece, she's dislodged by bank losses and the recession. Helen's weight puts this enormous, unexpected strain on the common rope, which makes the next weakest climber, let's say Paddy for Ireland, struggle and eventually fall too, followed by others like Portugal, Spain, and Italy.
And this strain creates a vicious, self-reproducing feedback loop. Describe how that loop accelerates the crisis.
Well, the initial strain on public finances from the recession and the bank bailouts leads the financial actors, the banks and hedge funds, to bet heavily on state default via CDSs.
Right.
That action immediately pushes up borrowing interest rates for the weakest links, further shoving them toward bankruptcy. Then the EU institutions come in and enforce austerity policies, massive cuts to spending, pensions, wages, which inevitably worsen the recession, shrinking GDP and tax revenue.
And when GDP shrinks, the bankers' doubts about being paid back are inflamed, which leads to even higher interest rates, which then demands more austerity. It just cycles.
Exactly. The crisis constantly reproduces itself because the prescribed solution austerity exacerbates the underlying problem of shrinking demand and increasing public debt ratios. It's like draining the mountaineer's water bottle while they're hanging from the rope, expecting it to make them lighter and stronger. The expensive new loans and the EFSF failed because they addressed neither the fundamental banking crisis nor the lack of a recycling mechanism. They only guaranteed that the Eurozone's deficit states and Europe's banking system would continue drowning together.
We've established the Minotaur's death and the Eurozone's structural failure. So now let's move to systems mapping. Let's clearly define the roles, the incentives, and the narratives that uphold this persistent dysfunctional structure that emerged post-2008.
Okay, let's map the key actors and their roles. First, the surplus nations, primarily Germany and the Netherlands, they maintain their export dominance and capital accumulation through wage restraint. Their role is to demand strict fiscal discipline from others, but resist any structural changes internally.
Okay, then you have the other side.
The deficit nations Greece, Italy, Spain, Portugal. They're defined by their reliance on the now defunct Minotaur for export demand, their absorption of toxic capital inflows pre-2008, and their subsequent crippling debt servicing burdens. They are essentially trapped.
Then you have the financial sector, the banks Wall Street and the big European banks, who successfully socialized their colossal losses post-2008 and then, as we said, used public money and instruments like CDSs to bet against the very states that had just saved them. This is the bankruptocracy in action.
Right. And then you have the EU institutions, the European Central Bank, ECB, the Commission, the EFSF. They are struggling mightily to contain the crisis within their institutionally problematic frameworks. Lacking a central fiscal mechanism, they really only have one policy lever to pull: austerity enforcement.
So we shouldn't forget the U.S. in all this.
No, we mustn't. The U.S. financial system, Fed. Post-2008, the Fed relies solely on monetary policy quantitative easing, or QE, as the only remaining lever to prevent deflation and a total collapse in aggregate demand globally. But this action, however necessary for stabilization, has had huge political consequences, inadvertently giving rise to severe domestic political backlash against the established financial order.
Now let's dig into the incentives. If the crisis could be resolved with a few economically rational steps, why hasn't it been? What are the design flaws that make this failure persist?
The persistence is rooted in the immense political leverage gained by the dominant actors. The incentives of the surplus nations are paramount here. Maintaining the crisis, or at least keeping it simmering along, grants them immense bargaining power over France and the deficit countries.
How so?
They get all the benefits of the common currency, securing their large intra-Eurozone surpluses, yet they retain the crucial implied option of getting out of the Eurozone if the demands of the periphery become too high.
So, the status quo, as painful and depressing as it is for the periphery, actually preserves the structural dominance of the surplus core. They are, in a sense, winning by not fixing the problem.
Precisely. And on the other side, the deficit nations are incentivized towards Political compliance with austerity, signing the required memoranda, implementing painful cuts, just to receive the next tranche of stopgap funding. They do this even when, intellectually, every political actor knows these policies are guaranteeing a deeper depression. Compliance secures the next loan.
And this political compliance shields the banks. That predatory power you mentioned, the bankruptocracy, means that failed financial institutions gained an extractive, predatory political power to continue extracting a larger and larger share of a shrinking national income through debt servicing.
It's a system where failure is rewarded with power. And to defend this deeply dysfunctional structure, you need powerful narratives that shift the blame.
This is where perception management comes in, the narrative of fiscal responsibility versus the reality of systemic failure.
And the most toxic and potent narrative, especially in the German-speaking world, is what Varoufakis calls the grasshopper narrative. It's a moralistic reframing of economics. The German public was successfully convinced that they escaped the worst of the crisis due to their superior thriftiness and hard work.
Contrasting with the spendthrift Southerners.
Exactly. The grasshoppers who failed to save for winter.
Wow, that seems incredibly effective politically. But if the data clearly shows German surpluses were dependent on the Minotaur's demand generation, why was the German public so easily convinced this was purely a moral failing of the South?
Because it's psychologically comforting, and it grants political actors immense moral righteousness. Admitting the truth that Germany's surplus depended on American debt and reckless financialization, and that the Eurozone design itself was fatally flawed, that would require collective political humility and accepting shared liability. It's so much easier to enforce structural dominance by framing the periphery's suffering as a moral consequence of their own laziness and profligacy.
And that framing.
It fuels a desire to punish the grasshoppers, even if that punishment is economically self-destructive for the Eurozone as a whole.
That desire for punishment leads directly to the question of persistence. Why does this system, whose failures are so widely recognized by rational economists, endure? Varoufakis uses this deeply cynical, yellow button thought experiment to explain the resistance to rational fixes.
Right, the thought experiment. It places a German chancellor at a desk, facing two buttons, a red one and a yellow one. The red button represents the economically rational, system-fixing solution.
And what does pressing the red button entail? What's the fix?
It requires mutualization of Eurozone risk and debt. Maybe the ECB takes on common debt, which would make a Eurozone exit impossible, a rising growth driven by a true surplus recycling mechanism, and debt levels dropping below the Maastricht limits. The red button ends the crisis quickly, restores growth across Europe, and fundamentally stabilizes the Eurozone.
Sounds great. What's the downside for the chancellor?
The downside is that pressing it also instantly debases the German simulacrum. It forces Germany to share the liability, it removes their current account advantage, and it fundamentally removes their immense bargaining power over France and the periphery. Plus, it would infuriate the grasshopper-believing electorate.
Okay, so that's a red button. What about the yellow button?
The yellow button maintains the current status quo, but protracted. The crisis continues to bubble along in a controlled fashion for maybe another decade. Germany retains its structural dominance, keeps its immense bargaining power, and enjoys extremely low interest rates for German businesses and homeowners. Meanwhile, the periphery Greece, Spain, Italy descends into a deeper, prolonged debt deflationary spiral, suffering massive losses in national income and permanent stagnation.
That's a path of guaranteed protracted pain for millions of Europeans. Why would the chancellor ever choose the yellow button?
Because for the politician operating within that established political system, the yellow button is far more attractive than the red button. Pressing the red button, letting the Greeks and Italians off the hook so easily, without years of penance and austerity, would be political suicide, given the electorate's deep conviction in the moralistic grasshopper narrative.
So the political cost of being seen as rational is perceived to be higher than the ongoing guaranteed economic depression in the periphery.
That is a profound statement about the priorities of modern democracy and the power of narrative. The political momentum, driven by this insistence on punishing the periphery, reinforces resistance to all rational fixes. Things like the three-step proposal suggested in the sources: comprehensive bank write-offs, transferring Maastricht-compliant public debt to the ECB, and immediately using the European Investment Bank as a genuine recycling mechanism to fund joint growth-oriented projects.
So the system persists.
It persists not because of economic necessity. The resources for a fix are clearly there, but because of the maintenance of internal political power structures. The result, as Varoufakis states, is alchemy in reverse. The integration project started with the goal of a common currency and ended up with the institutional equivalent of lead.
We've established the structural cause and the political resistance. Now let's shift to the present-day implications. The sources were updated post-2013, giving us a view of the temporary policy fixes that happened in the immediate aftermath, things like LTRO and OMT. What did these short-term patches reveal about Europe's fundamental problem?
They confirmed that the Eurozone leadership was wholly committed to short-term political appeasement over structural, systemic change. Take the ECB's long-term refinancing operations, the LTRO, in late 2011 and early 2012. This involved the ECB printing $1 trillion, a massive liquidity injection, and lending it to insolvent European banks in exchange for some pretty questionable collateral.
That sounds like a massive bailout attempt, but cloaked in monetary policy jargon.
It was. And it bought the Eurozone about 9 months of calm by providing liquidity and allowing banks to continue funding themselves. But it didn't address their underlying insolvency or the lack of aggregate demand. It just kicked the can down the road.
And what about the Greek debt write-off?
Right. The partial write-off in 2012, sometimes called the private sector involvement or PSI, on the surface, this sounded like relief, a massive haircut on debt held by private creditors. But the debt write-off was unique in history because it was conducted alongside such vicious austerity policies and depression that it left Greece with a heavier debt burden.
How is a write-off heavier? That doesn't make sense.
Because the recession was so severe. While the nominal debt number was reduced, the associated catastrophic collapse in Greece's national income, its GDP, meant that the crucial debt-to-national income ratio actually rose, despite the write-off. The numerator shrank, but the denominator shrank much, much faster. The medicine of austerity combined with the debt relief was lethal.
And finally, the outright monetary transactions, OMT, announced in 2012 by the ECB. This was the moment Mario Draghi famously promised to do whatever it takes.
OMT was the ECB's announcement that it would buy unlimited Italian and Spanish government bonds in secondary markets to keep their borrowing interest rates manageable. It calmed the markets, but it came at a monumental cost. To keep Germany and the surplus nations on board politically, OMT was made strictly conditional on further austerity and inspection by the European Commission.
And the consequence of that conditionality?
The consequence was severe. Europe's central bank sacrificed its most prized principle, central bank independence, on the altar of appeasing Germany. It chose to conduct monetary operations that stop when political inspectors say so, rather than when the ECB judges necessary based on economic data. This institutional compromise really highlights how political dominance trumped sound economic policy.
Let's shift back to the global stage. The Minotaur's death didn't just break Europe, it broke the global architecture of trade. How does the missing GSRM affect China, one of the Minotaur's primary feeders for decades?
China is facing a profound and unprecedented conundrum. Its economic model, built on relentless export growth, grew up entirely reliant on the Minotaur for external demand. Now, with the Minotaur wounded and generating 24% less external demand than needed, China cannot simply step up and fill the role of the new GSRM.
Why can't China simply replace the U.S. consumer? Why can't it just generate enough domestic demand internally?
Because of the deep structural flaws in its own system. For decades, China intentionally suppressed domestic consumption to fuel investment and exports. Its consumption to GDP ratio has actually been falling, dropping from nearly 50% in 1990 to just 29% by 2011.
Wow, that's low.
It's incredibly low. The savings rate is too high and the social safety net is too weak to allow its citizens to consume like American citizens do. Since consumption is falling, investment has had to carry the burden of growth. Investment rose dramatically, hitting 58% of GDP in 2011, which fuels massive infrastructure and real estate bubbles, the kind of unstable growth that creates ghost cities and excess capacity.
So they're in a bind.
An impossible trilemma. Either they let consumption fall further, or they let the investment and real estate bubbles grow unchecked, risking a catastrophic domestic implosion, or they choke off industrial growth by restraining credit. The Minotaur's passing has guaranteed a highly precarious, insecure world for China.
But China is not passive. They're pursuing something akin to their own partial global plan channeling outbound capital flows to create new demand. This sounds like the genesis of the Belt and Road Initiative, even if it wasn't fully named that yet.
That's the strategic shift. Recognizing the U.S. market is no longer sufficient, they are channeling massive amounts of capital, loans, and investment to countries like Brazil, Argentina, and across Africa. The goal is clear: to stimulate demand for Chinese goods in those emerging markets, effectively creating new export destinations and recycling loops that bypass the wounded West. We saw Chinese foreign direct investment in Brazil explode from negligible amounts to $17 billion in 2010 alone.
This leaves the global economy in an entirely new and precarious geopolitical arrangement, the triangular game of chicken.
That is the perfect description. You have the U.S. still running deficits but without a functional recycling mechanism. You have China trying to find new outlets for its industrial surplus and export model. And you have the emerging nations caught between relying on U.S. demand and accepting China's capital flows, often at a high interest or in exchange for strategic resources. With no dominant party, no common objectives, and no efficient global recycling mechanism, the world economy is guaranteed to be permanently stagnation-prone.
And beyond the sheer economics, the collapse of the Minotaur structure has fueled political fragmentation across the West, both in the U.S. and Europe. How does that systemic failure translate into political toxicity?
Well, the economic anxiety, the stagnation, the loss of stable middle-class jobs, it all translates directly into generalized political anger. In the U.S., the failure to pass meaningful, large-scale stimulus packages led to total reliance on the Fed's monetary policy, on QE. And the sight of Wall Street actors, who are primarily responsible for the crisis, returning as saviors wielding trillions of QE dollars, fed the rise of the radical loony right, epitomized by the Tea Party movement.
And the irony is that these groups denounced the Fed's interventions, like QE and bailouts, even though economically they were politically relying on those interventions to prevent a complete collapse that would have instantly wiped out the leverage they had against the establishment.
Exactly. Meanwhile, in Europe, the economic anxiety was channeled through that moral lens of the grasshopper narrative. The generalized anger, the xenophobia, even the rise of neo-Nazi movements in places like Greece and Hungary were fueled by this moralistic belief that suffering was a deserved punishment for the periphery's fiscal sins. This atmosphere further reinforced the political willingness to push that self-destructive yellow button and perpetuate the crisis indefinitely. The Minotaur's death did not just cause a financial crash, it initiated a global political decompression chamber.
This entire analysis speaks directly to the core themes of crisis and perception. The central insight the book offers is the constant, intentional reframing of structural failure as moral failure.
It is the ultimate lesson of the book. It demonstrates how economic suffering, whether it's the collapse of youth employment in Spain, pension cuts in Italy, or the deepest depression in modern Greek history, is routinely and intentionally reframed as individual profligacy or moral laziness.
And
That narrative completely and successfully diverts public and media attention from the empirically strong systemic design flaws of the Eurozone and the failure of the global GSRM.
And once you accept that framing, that it's a moral crisis, then the only policy prescription that follows is punishment and austerity. Structural solutions are automatically dismissed.
Yes. There is a deep institutional resistance among policy elites to accepting a structural explanation because that would require them to fundamentally change the power dynamics within the Eurozone. They prefer to focus on technical minutiae that sound complicated but are ultimately irrelevant to the core problem.
For example, obsessing over the technical details of OMT conditionality or the political feasibility of federal debt sustainability in Italy.
Exactly. These are questions that sound technical and minor, and they do indeed determine the fate of nations, but they are irrelevant distractions from the core existential problem, the absolute necessity of a functioning surplus recycling mechanism, both globally and regionally. The focus on technicalities is the primary way the status quo of structural dominance is maintained.
And the final tragic systemic outcome of this failure to fix the architecture is the emergence of what Varoufakis terms the bankruptocracy.
That's the system that emerged post-2008, where failed financial institutions, those banks deemed too big to fail, who then grew even bigger, gained this immense extractive predatory political power. This system is inherently introverted and focused on extracting existing wealth from shrinking national income through debt servicing and rent seeking, rather than generating new wealth through productive investment. As long as this bankruptocracy persists, driven by the handmaidens of the dead Minotaur provincial mercantilism, political appeasement, and absurd European institutions, genuine, sustained recovery is impossible without a complete systems overhaul.
To conclude our deep dive, let's reflect on the profound insights the Minotaur metaphor reveals about the architecture of modern global capitalism and European integration.
First, about global capitalism. The book compels us to recognize that systemic stability is not a natural outcome guaranteed by free markets or technological innovation. It requires a consciously managed global surplus recycling mechanism, a GSRM, that markets, however efficient, simply cannot provide on their own. The Minotaur was, in essence, a terrible beast built on debt and financial recklessness, but it filled a necessary structural gap from 1971 to 2008.
And second, regarding European integration.
It was built on fundamentally and fatally flawed architecture. The Eurozone was a fair-weather machine, only functional during the Minotaur's reign, which successfully papered over the lack of any internal balancing mechanism or shock absorber.
Which means the crisis itself was avoidable.
And that's the third point. The ensuing European sovereign debt crisis was unnecessary from a purely economic viewpoint. The resources were absolutely there for a swift, rational resolution. But the crisis became essential for the maintenance of political power structures within Europe specifically, preserving Germany's structural bargaining power and upholding that comforting moralistic narrative that shielded political elites from accountability.
So, stability versus growth. In the absence of a new functioning GSRM globally or regionally, what reality are we settling into?
We are settling into a state of permanent instability, chronic uncertainty, and a never-ending slump. This is ruled over by the Minotaur's surviving handmaidens, bankruptocracy, mercantilism, and institutions built on compromise and political expediency rather than sound economic design. It is an illogical, absurd world where the reduction of global imbalances, like America's trade deficit shrinking, actually makes the world more volatile and stagnation-prone.
Finally, the reflection offered in the source material challenges us to look beyond policy and look at agency. A wholesome GSRM, the book suggests, requires the U.S. to lead once more, perhaps for the last time, by grasping the meaning and irreversibility of the Minotaur's demise and accepting the dystopian prospect of a stagnation-prone world.
That is the open question we are left with. The world is perhaps too complex for a single country to fill the Minotaur's shoes again, but without agency, without history's actors emerging with the audacity to smash pre-existing realities and fashion new, rational, collective futures, as the U.S. did twice before, we risk being condemned to this prolonged, painful postmodern 1930s.
Our deep dive today was into Europe after the Minotaur, Greece and the Future of the Global Economy by Yanis Varoufakis. We highly recommend reading the book or borrowing it from a library to explore the system's analysis in greater depth. This project is free and publicly accessible. If you'd like to support the time, tools, and research behind Crisis and Perception, you can become a supporter on Patreon. For a shorter visual overview of this topic, see the mini explainer linked in the description. If you enjoy this kind of systems-level analysis, please like, subscribe, and comment with books or topics you'd like us to explore next.